No.1 Pfizer. Pharmaceutical giant Pfizer reported a surprise profit for Q4 2023 as sales of its COVID-19 medications performed better than anticipated. The drug maker reported Q4 earnings per share of 10 cents compared to a loss of 22 cents that had been expected. Revenue totaled $14.25 billion versus $14.42 billion that was forecast on Wall Street. Despite the surprise profit, Pfizer's overall sales were down 41% from a year earlier, sending PFE stock lower. Year-to-date, PFE stock is down 13%. That takes its decline over the past 12 months to 37%. Through 5 years, Pfizer's share price has decreased 35%, making it one of the worst-performing healthcare stocks. The company has struggled with a rapid decline in its COVID-19 business, where demand has dropped as the medications transitioned to the commercial market. The company has also struggled to develop a weight loss drug, canceling a planned weight loss pill after poor clinical trial results. Looking forward, the pharmaceutical company said it hopes that its $34 billion acquisition of cancer drug maker Seagen, which closed during Q4 of last year, will restore investor confidence. Though beaten down, PFE stock pays a quarterly dividend of 42 cents a share, good for a high yield of 6.17%. Number 2 UnitedHealth Group. UnitedHealth Group has also been clobbered by Medicare Advantage. The largest healthcare insurer in the U.S. reported Q4 2023 financial results that beat Wall Street forecasts on the top and bottom lines. The company reported EPS of $6.16 and revenue of $94.4 billion for the final quarter of 2023. That was better than the consensus forecast of analysts that called for earnings of $5.98 a share and revenue of $92.1 billion. However, the earnings beat was overshadowed by a utilization rate for Medicare Advantage services that was higher than expected. The company said its medical loss ratio for Q4, which tracks the proportion of premiums paid to cover medical expenses, was 85%. Analysts had expected a medical loss ratio of 84%. Again, a higher medical loss ratio is of concern to analysts and investors because it means more spending on medical expenses and less room for profit. A higher-than-expected utilization of medical services by patients enrolled in Medicare Advantage is a growing issue for UnitedHealth, and it's hurt the share price. So far in 2024, UNH stock is down 18. Trading at 19 times future earnings estimates and with a quarterly dividend of $1.88 a share for a yield of 1.65%, UnitedHealth Group looks attractive at current levels. Number 3 Abbott Laboratories. Abbott Laboratories has increased its dividend for over 52 years, making it one to watch among strong-buy healthcare stocks. It now belongs to the elite group of dividend aristocrats, which attracts investors looking for a reliable source of income. The payout ratio is nearly 62%, which leaves room for growth. Abbott's financials have grown significantly due to the company's strategy after the global pandemic. Abbott increased their R&D spending during the height of the demand for COVID testing, creating over 25 new growth prospects. The trend of innovation continues post-pandemic. Abbott has introduced the Assert IQ insertable heart monitor, a gadget that enables long-term monitoring of irregular heart rhythms, after receiving FDA approval. In addition, the FDA Advisory Committee also gave Abbott's TriClip system a positive vote for treating leaky tricuspid heart valves. Abbott also announced Protality, a new weight loss brand for adults and the world's smallest rechargeable system for treating movement disorders with remote programming capabilities. The tremendous earnings power of Abbott's broad portfolio is evident in its growth profile. Despite a dip in revenue from the company's diagnostic segment due to reduced demand following the end of the pandemic, Wall Street analysts still forecast that this healthcare behemoth will achieve a top-line growth of more than 11% in 2024 and 2025. Number 4 Johnson & Johnson. Johnson & Johnson is another dividend king among the biotech stocks to buy in April. The company has increased its dividend in each of the last 62 years. When you consider just how much the economy has been through in that time, you'll understand why Johnson & Johnson stock offers such great value. Johnson & Johnson stock has been in a downtrend since August 2023. That has continued into 2024 with the stock down 7.78% in the year to date. This is a period in which investors are pricing the company without its personal care division, which spun off as Kenvue early in 2023. But the bullish case for Johnson & Johnson revolves around its recent announcement that it was acquiring Shockwave Medical for $13.1 billion. That gives J&J's growing medtech division access to Shockwave's first-to-market intravascular lithotripsy technology using sonic pressure to crack calcium lesions in arteries, similar to the process used to break up kidney stones. Number 5. AbbVie. AbbVie stock was in a downtrend over concerns about the patent cliff for its flagship drug, Humira. And it's fair to note that AbbVie's top and bottom line numbers are down on a year-over-year basis in the last 2 quarters. That being said, the company has still beaten analysts' expectations in both quarters. And the stock is up 14.2% in that time. One reason is the erosion in Humira revenue hasn't been as bad as feared. The other is the company is making up for a good bit of that lost revenue through sales of Skyrizi and Rinvoq. AbbVie consistently posts a return on equity greater than the industry average. Some naysayers will point to the company's high debt-to-equity ratio as a reason for that strong ratio. However, a forward P/E ratio of just 15x reflects the value present in AbbVie stock. Plus, you're getting a dividend king that has increased its dividend for 52 consecutive years and has a 3.44% yield.